In October 2008, in Phoenix, Arizona, Daniel Mercer, a 42-year-old real estate agent, stood in front of the 4-bedroom house he had bought just 2 years earlier for $410,000. When he signed the contract, the bank assured him the U.S. housing market was unlikely to collapse on a large scale. He believed it. The whole neighborhood believed it. 2 years later, the house was revalued at $185,000. The loan remained. The property value had evaporated by more than 50%. But Daniel wasn't alone. In just 18 months, more than 8 million homes in the U.S. fell into negative equity. What was once considered the safest asset for the middle class had become a debt burden. And even more significantly, before the collapse, no one considered real estate a foregone conclusion. Financial history shows that in every crisis, there are always types of assets that were once considered permanent, unbeatable, systematically guaranteed, etc., and then almost completely disappear from the balance sheets of millions of people. Stocks were once a symbol of industrial prosperity in 1929. Imperial bonds were considered the most secure in Europe before 1917. Icelandic bank shares were touted as a national pillar in 2007. In just a few months, their value was almost zero. The worrying thing isn't the asset's price drop. Every market has cycles. The worrying thing is the mechanism that causes an asset to be wiped out, not just a 10% drop, not a 20% correction, but the loss of almost all of its value. And when you look beyond the surface layers, a list begins to emerge repeated over the centuries. These are the assets that seem most stable, yet are the most fragile when the monetary system enters the final stages of its cycle. Today, we will go through 8 types of assets that have been wiped out in major crises throughout history. Not to scare people, but to identify the mechanism. Because when the mechanism repeats itself, the consequences are rarely random. In every crisis, there is always a layer of collective belief that protects those assets until the very end. People don't lose money because of a lack of information. They lose money because they believe that this time will be different. Stocks always recover in the long term. Real estate cannot fall across the board. Government bonds are risk-free. Banks are too big to fail. Deposits are insured. National currencies are symbols of sovereignty. Pension funds are guaranteed by law. And large corporations are irreplaceable pillars. These arguments are not entirely wrong. Under stable conditions, they work. Problems arise when the monetary system begins to become severely imbalanced. In the late stages of the debt cycle, 3 factors often appear simultaneously: high leverage, asset valuations far exceeding real earnings, and the belief that the state can always intervene to prevent collapse. When these 3 factors converge, assets are no longer valued based on cash flow, but on expectations of bailout. History shows that when the system is forced to adjust, what is wiped out is not the weakest asset. It is the asset built on the most skewed expectations. In 1929, U.S. industrial stocks traded at unprecedented P/E ratios. When margin lending tightened, more than 80% of market value was wiped out in 3 years. In 1997, commercial real estate in Bangkok increased in value by more than 200% in just a few years thanks to short-term USD capital inflows. When the exchange rate collapsed, the market almost completely froze. In 2001, dot-com tech stocks were valued based on traffic rather than profits. When liquidity disappeared, thousands of companies vanished from the exchange. Each period has its own story. But if you peel back the surface media coverage, the underlying structure is strikingly similar. Financial leverage amplifies profits during growth phases. Valuation expands based on unlimited expectations. And when the flow of money reverses, forced liquidation begins. Assets don't just depreciate. They are liquidated, seized, nationalized, diluted, restructured, or simply no longer traded. That's how wiping out happens in reality. And looking back over the centuries, 8 asset classes that frequently appear on this list begin to emerge. First are speculative stocks built on expected growth rather than actual returns. Second are highly leveraged real estate. Third are government bonds of insolvent nations. Fourth are bank stocks when the credit system collapses. Fifth are domestic currencies during hyperinflation. Sixth are pension funds dependent on a continuously rising market. Seventh are businesses that rely on short-term debt to finance long-term investments. And finally, are derivative financial products priced based on the assumption of perpetual liquidity. But this is just the tip of the iceberg. More importantly, we need to understand why these assets repeat themselves across different periods, different countries, and different political regimes. Because when a pattern repeats enough times, it's no longer a coincidence. It becomes a structure. And that structure begins with the operating mechanism of the modern monetary system. To understand why these assets are wiped out, we need to peel back the surface layer of price fluctuations and delve into the operating mechanism of the system. An asset doesn't naturally die. It's brought into a state where its market value no longer reflects true ownership. At that point, the balance sheet becomes the battlefield. The mechanism usually begins with credit. During the expansion phase, the banking system creates money through lending. New credit not only finances production, but primarily flows into assets, stocks, real estate, bonds. Prices rise, collateral increases, and banks can lend more. An amplification loop is formed. When asset prices rise, the feeling of wealth spreads. Owners feel more secure, consume more, and borrow more to invest further. Financial institutions package risk into new products, distributing them throughout the system. Leverage is no longer concentrated at one point, but spreads across the entire network. At the peak of the cycle, asset prices no longer depend on the underlying cash flow. They depend on the ability to refinance. As long as credit continues to expand, prices can continue to rise. But when interest rates rise, or capital flows reverse, the reverse cycle begins. Prices fall, causing collateral to depreciate. Banks demand additional collateral. Investors are forced to sell to repay debt. This selling causes prices to fall even further. Liquidity shrinks, and the market becomes one-sided. This is the negative feedback loop. In the 1929 crisis, the margin lending system forced investors to sell stocks when prices fell. Forced sell-offs caused the market to lose nearly 90% of its value in a few years. During the 2008 global financial crisis, securitization of mortgage loans spread risk across the balance sheets of global banks. As home prices fell, collateral assets depreciated, and banks lost trust in each other. The interbank market froze. When liquidity disappeared, assets had no buyers at any reasonable price. That was the moment an asset was wiped out. Not because it was physically worthless. A building still stood there. A company still had employees. A bond still had a payment obligation. But without a trading market, without anyone willing to take the risk, the book value became just a number on paper. And during this period, a crucial process took place: asset transfer. Highly liquid investors bought the liquidated assets at deep discounts. Those who use high leverage are being taken out of the game. This isn't just an economic recession. This is a large-scale redistribution of wealth. During the hyperinflation of the Weimar Republic in 1923, local currency cash almost completely lost its value. Owners of tangible assets such as land or foreign currency retained their relative value. The middle class, dependent on local currency savings, was wiped out. In the Icelandic banking crisis of 2008, 3 major banks collapsed almost simultaneously. Their stock prices plummeted to near zero in just a few weeks. When a system enters a correction phase, it's not the weakest assets that are wiped out first. Rather, it's the assets most dependent on credit and continued trust. And if we look at the current structure of the global economy: corporate leverage, record high public debt, asset markets priced based on abundant liquidity for over a decade, a question begins to silently form. Where does the current cycle stand? If we place those mechanisms against the current data, the picture becomes hard to ignore. Global debt has far exceeded the size of world GDP. In many developed economies, public debt exceeding 100% of GDP is no longer the exception but has become the norm. Non-financial businesses have accumulated the highest leverage in decades. Households in some countries spend more than 40% of their income on housing and interest payments. Meanwhile, stock valuations in major markets have reached historical highs based on cyclically adjusted P/E ratios. House prices in many cities have outpaced average incomes for over a decade. The bond market has experienced near zero, or even negative, yields, an unprecedented event in modern monetary history. Simultaneously, policy interest rates have undergone their fastest rising cycle in decades to control inflation. The cost of refinancing for governments and businesses has risen sharply. Corporate profits are under pressure while the cost of capital is higher. Comparing this structure to the period before 1929, we see a common thread: asset valuations significantly higher than real income growth. If we compare it to 2007, a similar pattern emerges: high leverage, inflated collateral, and the belief that monetary policy can handle any shock. The credit yield spread, an indicator of systemic risk, has repeatedly widened abruptly before major recessions throughout history. A similar phenomenon is repeating itself cyclically. Commercial real estate markets in some major financial centers are experiencing record high vacancy rates. Valuations are plummeting while the volume of debt maturing in the next few years is enormous. This is a structure that has previously preceded large-scale asset restructuring waves. At the same time, global capital flows are becoming more sensitive to interest rate fluctuations and geopolitical shifts. Liquidity, which had been abundant for a decade, is no longer guaranteed. No single indicator definitively guarantees a crisis. But when the data are put together, a sense of familiarity emerges, a feeling that has been present before major turning points in financial history. And when the system is under pressure, it's not just corporate balance sheets that suffer. The middle class is where the shock is felt most acutely. Homes, the biggest asset for many families, become illiquid. Retirement savings depend on volatile stock markets. Small businesses face high capital costs and weakening consumer demand. The younger generation, already facing high housing prices and large student debt, is locked out of access to assets. They delay buying homes, delay starting families, delay having children. Birth rates in many developed economies have fallen to record lows. Prolonged financial pressure creates social instability. Confidence in the system is eroding. Intervention policies are implemented to alleviate short-term pain, but they can also prolong long-term imbalances. In that environment, the story of the top 8 assets wiped out is no longer a distant memory. It serves as a reminder of how the system adjusts when pressure builds up sufficiently. And when the adjustment begins, it rarely happens smoothly. The problem is, when the system has accumulated too much leverage and high valuations, there is no easy way out. If interest rates remain high, the cost of servicing debt for governments, businesses, and households will increase. This reduces profits, decreases consumption, and drags down growth. But if interest rates fall too quickly to support asset markets, inflation could return, eroding purchasing power and undermining confidence in the currency. Politics doesn't allow asset prices to collapse freely. Housing is the asset base of the middle class. The stock market is a gauge of national sentiment. The banking system is the backbone of credit. Any major shock has social and political consequences. Therefore, policy often chooses the path of delay, refinancing, debt extensions, liquidity injections, conditional support. This slows down the adjustment but doesn't eliminate the underlying pressure. The system falls into a state of stagnation. Asset prices cannot rise sharply as before because the cost of capital is higher. But they also cannot fall sharply immediately because of policy support. Liquidity becomes selective. Weak businesses are gradually eliminated. Market sectors heavily reliant on short-term debt begin to crack. This isn't a moment of massive collapse. This is a process of erosion. In such an environment, wiped-out assets don't disappear in a day. They weaken quarter after quarter, with each financial report, with each restructuring. Stocks are diluted through multiple rounds of issuance. Bonds are swapped at deep discounts. Real estate is transferred to creditors. And as confidence declines, defensive money flows emerge. Liquidity withdraws from high-risk areas and concentrates in what is perceived as safer. This process reinforces itself. Looking back at history, the period before major turning points is often not the most chaotic. It is a prolonged period of tension, where the system maintains a fragile equilibrium while underlying pressures mount. In 1930 to 1932, many American banks did not collapse simultaneously. They closed one after another as depositors lost confidence. In 1990 in Japan, the asset bubble did not burst in just a few months. It led to a decade of stagnant growth and a prolonged decline in asset prices. When adjustments occur in that way, the damage is not noisy but profound. Assets lose their real value over many years, and by the time the cycle ends, the ownership structure has changed. Identifying this pattern isn't about predicting timing. History rarely repeats itself on a precise schedule, but it leaves its fingerprints. Every major crisis shares a common denominator: high leverage, valuations far exceeding real earnings, belief in perpetual bailouts, and ultimately, a redistribution of wealth. From the 17th century tulip mania, the 18th century South China Sea bubble, the Great Depression of 1929, the 1997 Asian financial crisis, to the 2008 global financial crisis, this structure repeats itself in different forms but with similar mechanisms. Assets aren't wiped out because they exist. They are wiped out because the system for valuing them is based on unsustainable beliefs. And when beliefs change, history doesn't ask anyone's opinion. Ultimately, when all the layers of data, mechanisms, and history are put together, the story no longer revolves around 8 individual asset classes. It revolves around a deeper question: what exactly is an asset in a credit-based monetary system? If money is created through debt, then much of the asset value exists thanks to the ability to expand debt. As credit expands, asset prices rise. As credit contracts, asset prices adjust. This means that the ownership we believe to be sustainable actually depends on external financial conditions outside the individual. A stock represents ownership of a business, but its market price depends on the cost of capital and systemic liquidity. A house is a physical dwelling, but its market value is tied to interest rates and borrowing capacity. A government bond is a promise of payment, but that promise is only as strong as the ability to collect taxes and confidence in the currency. As the monetary cycle enters its final phase, the distinction between price and value becomes apparent. Price is the number traded today. Value is the ability to maintain purchasing power and ownership over time. In periods of stability, this gap is almost invisible. In crisis, it becomes apparent as a long crack. 8 assets that have been wiped out in history weren't rendered useless. They were swept away at a point where the financial structure no longer supported their previous valuations. And when the system adjusted, the shift in ownership occurred faster than the public perceived it. It's worth considering: each generation believes the current system is more complex and better managed than the past. Better technology, more data, more sophisticated policies. Yet the cycle repeats itself. Not because people lack intelligence, but because the dynamics of power and incentives within the monetary system don't change much over time. Growth based on credit always creates short-term prosperity and long-term risk. When the risk accumulates sufficiently, correction is inevitable. Daniel's story in 2008 wasn't just about an individual losing their home. It was an example of a cycle. The stories of those who lost their savings in hyperinflation, or bank shareholders whose stock value was wiped out, are similar. Each crisis is a test of collective confidence in assets and currency. and after each one, the economic structure is restructured, with different winners and losers. Perhaps the current cycle will adjust gently. Perhaps it will linger in a state of simmering tension. Or perhaps a sudden shock will force the system to rapidly revalue. History offers no definitive answer. But it leaves a clear message: assets don't exist in a vacuum. They live within a monetary structure, and that structure is cyclical. When looking at assets that have been wiped out, it's not just about the past listings. It's about understanding where we stand in the current cycle, and our role in that structure. Because before an asset is wiped off the price chart, it's always believed to be safe. And when beliefs change, things change.